Welcome to this morning's panel session. I'm Neil Erickson. I'm an economist at the Federal Reserve Board. In the usual spirit, anything that I say does not necessarily represent the views of my employer. We have three fabulous panelists today to talk about nowcasting. And let me just give a brief introduction about nowcasting, talking about predicting the present, where we are now. Clearly, predicting the future is a very difficult task. But even knowing where we are now turns out to be very difficult and very important. If we are going to make forecasts about the future, it's very useful to know where we stand now. If I'm forecasting here, but in fact, the truth is over here, I'm going to systematically mispredict what is happening in the future. So nowcasting is important for forecasting. And it's also important in its own right because policy often depends upon where we are standing now. Now, the pandemic highlighted the importance of nowcasting. The economy was changing very rapidly with the pandemic spreading, lockdowns, people becoming unemployed very rapidly. And there was also very rapid policy response, response by my employer, the Fed, response by Congress with the Paycheck Protection Program and other programs. Conditions altered very rapidly and policy response followed. It's not the first time that this has happened. And I go back to the financial crisis. This is for two countries, for the US and for the UK, looking at the initial releases of GDP growth quarter by quarter, and also the final estimates. And 2008, in the UK, we're seeing annual mismeasurements of GDP growth of several percentage points. And in fact, GDP starts growing negatively in 2008, and yet it's not known that that happened. The same thing happened in the US, although not quite so dramatically as with the UK. So even knowing what's going on in the very recent past can be a real challenge. And I'll include that roughly in nowcasting, knowing what happened last month as well as this month, or last quarter as well as this quarter, is an important issue. The OECD, or rather Eurostat, had an entire volume dedicated to this topic back in 2017, Handbook of Rapid Estimates, many contributors, something like 700 pages long on different techniques to improve our estimates of what the economy is doing now. We have some aids for nowcasting. We have machine learning techniques to help process the data that we're getting, higher frequency data, including alternative data sources, such as Twitter feeds, Google Trends, you name your particular favorite social media feed. But there are also difficult challenges about getting data about the present. Challenges are that sometimes it's unavailable, it's incomplete, and inaccurately measured. And that applies particularly to these alternative sources because they're not being gathered in a statistically solid way, if you wish. They're voluntary. Who shows up on Twitter is a voluntary choice. It's not like going out and doing a survey. So although this higher frequency data, especially from alternative sources, may be more timely, more detailed, it has its own dynamics, noise, and structural breaks that will influence its interpretation. So, conference theme is on nowcasting and its roles in decision making. Two of the key questions that I see here: how have these tools and data sources contributed to nowcasting? And how do nowcasts serve policymakers? And with that, I'll turn the floor over to our three speakers, to Baoline, Neil, and Jason, to talk about nowcasting. The format will be they'll each talk for about 20 minutes on the relevance of nowcasting and the roles it plays in their agencies, and perhaps more broadly. And then we'll open it up for questions. So I do ask you hold your questions until after we've gone through the presentations, and then we'll very much welcome them. So to start, Ali.
And good morning. And I would like to thank the conference committee for the opportunity to share our nowcasting research here with everyone. And this is the project, and I have my colleague out here, so we've been working on this project. Well, as we just saw, the rapid estimate and the handbook by the Eurostat, actually there has been an ongoing effort from official statistical agencies and from IBM, the central bank, in search for techniques and methods that will produce more timely and accurate early estimates. And so this research is part of that effort. So this paper will evaluate the ability of individual nowcasting models or model averaging or forecasting combination techniques. In particular, we're looking at whether these techniques can help reduce revisions in the personal consumption of services in the United States national accounts. We are especially interested in the nowcasting of the first estimate at the most detailed level. So this is a little different from most of the research of forecasting, nowcasting. They focus on total GDP or big components of GDP, like consumption, investment. We're looking at consumption of services at the most detailed level. So we use the same data that were used in the production. So we show in a real time setting that nowcasting methods can help reduce revisions in the advanced estimates, which is the first estimate of PC services, in 91% of the detailed components that we included in this study. We evaluate the performances of all the techniques that we examined by comparing the least square revision for each component. And from our experience, our study suggests that nowcasting techniques are potentially a powerful tool that can help reduce revision in the early estimates in the national account statistics at the most detailed component. So we know the United States release the GDP each quarter 3 times, and with 1, 2, 3 months delay. And the timing of the release due to the availability of data. So when we have the first, or we call advanced estimates, actual quarterly data was still not available. GDP is built up from detailed components, like, people call it bean counting or bottom-up approach. And personal consumption expenditure is about 2/3 of GDP. And out of that 2/3, and 2/3 of that is personal consumption of services. So services end up taking about 47 to 48% of the total GDP. So it's the largest subcomponent in the GDP, which is a very important big component. So this project focuses on the statistical methods to reduce revisions in the first or the advanced quarterly estimate of each component of services. The source data for the consumption of services, they were never available for the first estimate or last estimate, and partially available for the second, and become available for the last or the third estimate. And because of the timing of the source data, the advanced estimates often later are revised. Uh, and they have to be estimated using the monthly indicators. Somehow give you some indication as where the actual estimate is going to become. So indicators for the PCU services have some shortcomings. First of all, there's an insufficient number of indicators for every component. Sometimes one indicator is used to approximate multiple components, just give a rough idea. And the indicators often have a poor correlation with the source data, quarterly source data. So, and as a result, there's a poor correlation with the third estimates. And there's the source data for PC services is from quarterly service survey by the Census Bureau. And advanced estimates of services often show larger revision when the source data became available. So here are just some examples. We can see the red line is the first estimate, and the green line is the third or the final estimate for each quarter. And the blue bar is the difference between the two that indicate the revision for a certain quarter in a certain component. So we can see sometimes the revision can be pretty significant. So the objective here is to try to look at different techniques in comparison to the current technique, which is the linear extrapolation method. We wanted to see if we can use some the extrapolation method does not use any past information from quarterly target variable, which is the component, and only uses the indicator for the current quarter. It doesn't use the past history. So we want to look at the techniques that allows to use all information available for the target and indicator. So because we're looking at the first estimate of each quarter, I think this is equivalent to consider that's a nowcasting approach, which includes you looking at the immediate past, where you just finished the quarter, you want to see what we have produced. So we don't have all the data available. We want to make a prediction of that. So we look at two types of techniques. One is the individual autoregressive distributed like type of models, and which allow both the target and indicator information. And also we look at a set of forecasting combination techniques, which we see if it will improve upon performances of the individual models. So to evaluate the performances of each method, we split sample into a training or estimation set, and also the testing set for pseudo out-of-sample predictions to evaluate performance of each technique. We use real-time data to compare performance with the current extrapolation method. The good thing is the BEA preserve all the data used in each quarter production. So the two individual models we use are the simplest. One is the bridge equation. Here we see that we use the past information on target variable and also the monthly indicators aggregated to the quarterly frequency. And very similarly in setting is what we call the, or in the literature called the bridging with factor model. So instead of using the monthly indicators, we have the factors, selected common factors, and aggregated to the quarterly frequency from the monthly factor model. So we wanted to see if the whole set of indicators for the service industry can help improve the estimation. In the bridge equation, that's the specific indicator designated for. And for the forecast combination techniques, we look at the following types, and we consider 10 model averaging techniques based on 4 kind of roughly categories. We have 4 simple averaging techniques: mean, median, and trained mean. We also have 3 information criteria-based averaging, ANC, BNC, and also non-penalized least log likelihood averaging. And we have a model fit-based averaging base ranger. And finally, we also look at the 2 more sophisticated quadratic minimization-based averaging, the jackknife averaging and Mallows averaging. We want to see whether, what they do with very detailed data. We define 10 model specifications for the averaging. So 5 based on the bridge equation, 5 based on bridging with factor model. The specifications distinguished by the number of lags allowed in the model. So from no lags to up to 4 lags, and in the 2 sets. So there are 10 models for averaging. And the data, we have 88 personal consumption of services components from 9 service categories. Real-time data starting from 2009 Q3 until 1920 Q4. So so far this part does not include the pandemic. The reason we started from 2009 Q3 is because that's where the quarterly service survey, the true source data became available. So we want to compare with the actual production. And for this set of components, we have 92 monthly indicators, the price indicators, so wage indicators, and other revenue indicators, factor model. So we split the time series into training and the testing samples. And from 2009 Q3 to 2017 Q4, 32 quarters, that would be it for estimation. And from there on, we have 1 step ahead to out of sample predictions of 11 quarters. So we looked at just the individual models, bridge equation and bridging with factors. And then we look at the model averaging group. By adding the model averaging techniques, we want to see if there's a further improvement. And for the bridge equation and bridging with factors, we allow a maximum of 4 lags in the target and indicator or the factors. And we let the program to select the best model in terms of how many lags needed. We use the AIC adjusted for small samples. So in the pseudo out of sample predictions, we use 1 step ahead recursive or expanding window design. So you estimate the model using up to the end of the estimation sample, then we predict the next step, right, next quarter. Then we re-estimate the model by adding 1 observation and then predict the next step. So we go forward until we reach. The evaluation of the techniques is based on the unit square revision and of the methods we're looking at and from the extrapolations. The general observation from the pseudo out of sample prediction, if we just use the bridge equation of bridging with factors or the individual models, then we find that we can reduce revisions root mean square revisions in 65 out of the 88 components that we tested. And that's 74% of that. And the bridge equation in compared to seems doing better than the bridging with factors model. Perhaps the designated indicator already carries sufficient information for that detailed component most of the time. That's what our kind of a hunch is. So here is a quick table. These are the simple services we have. And the number of subcomponents we add up, and number of large reductions, and using the current method, which is extrapolation, there are still 18 of them. Anyways, we have the third column is from what's the best model using bridge equation for that. For example, healthcare services, bridge equation to reduce the revision most in 10 of the components. And the logic reduction from bridging with factors model are listed on the last column. So this is if we just use the individual, two individual models. And then if we move forward to look at model averaging techniques, and the model averaging weights are computed only on the estimation sample. And the averaging weights are computed on also the expanding window, which means each time we make a prediction, we compute the average, make a prediction, then we re-estimate the model, recompute the weight. So it's just like when we have general observation of combined predictions, which is also true with the bridge equation and bridging with factors model, is that the characteristics of each component pretty much determine which model is best for that component. And the model averaging techniques reduce the root mean square revision in 80 out of the 88 components. So this increased from 64 to 80. So that's a 16 component or 18% increase compared with just individual techniques. And interestingly, the non-penalized log likelihood averaging did the best and produced the largest root mean square revision in 40 out of the 88 components. And it's interesting that without the penalty, not ASC, PSC, but non-penalized did the best. The degree of reduction in root mean square revision from model averaging techniques seems somewhat larger than the reduction of using just the bridge equation and bridging with factors. These are just from our data. So this table shows we can see there are 88 total components. From the log likelihood averaging, 40 of them produce the largest reduction. And here is the bridge equation bridging with factors. And actually more sophisticated averaging for the very short time series, very detailed data didn't really show much of a big advantage. And there are still 8 components. Extrapolation still did okay. So here we can probably just see, so this will include the individual bridge equation bridging with factor. If we lump all the model averaging techniques there, we can see that improve 63 of the 88 reduce their square revision. And the range of revision is also larger. Okay, so here are some results we can see. The red line is the extrapolation technique. This is in terms of revision. And the blue line is what the model prediction. And we can see this graph shows only the bridge equation and bridging with factors model. I think this is the bridge equation bridging with factor model, but we can see that the extrapolation induced revisions larger but more volatile. And these four components and revisions come from the model averaging techniques. The same thing here. We see the extrapolation technique produce the larger revision and the bigger up and downs. I think the important thing is to know the extrapolation technique doesn't use the time series data, it's quarters. So, but the time series models take into consideration of the dynamics. All right, so finally we talk about during the COVID pandemic lockdown, the routine collection of survey data and production of monthly indicators for advanced estimates were disrupted and delayed. But the high frequency credit card transaction data were used in the national account for some adjustment for the impact of a delay in the source data production. The national account had to make some adjustments because there's insufficient data for estimation. The credit card transaction data captures a broad range of spending activities, and they are available at high frequencies, making them a suitable indicator for current economic activities, especially during the turmoil times like 9/11 or financial crisis or pandemic lockdowns. So people still need to make transactions, but easier to use the card transaction. So we wanted to extend our study by looking at if credit card transaction data will add some information during this turmoil time. It is an ongoing part of our study. I'll just give you a little. So we start with something very simple. We have our base bridge equation as we had before. Then we have something we call extended bridge equation by adding the credit card transaction data there with lag. We also look at AR models with set AR four lags like in a year. Okay. And also we have AR model. We let the program to determine how many lags are needed. So that's another two. And finally, we still include an extrapolation procedure. This is the beginning of this work. We haven't included models or model averaging. We just want to have some kind of. So for this, because of the credit card transaction data does not cover all the components, we have 71 components of services, and we still use the real-time data. Now we have a little longer, the extend to 2020 Q4, so we have 46 vintages, and we also have 138 vintages a monthly indicators. So the credit card transaction data are collected by Pfizer Corporation, and the Federal Reserve Board, the researchers there, and Palantir Technology Company. They constructed a monthly series based on some very nice method. So we use their monthly series data for our study. We still split our sample into estimation and testing sets, and we still do the pseudo auto sample prediction for 2018 to 2020 Q4. The general observation from the pseudo auto sample prediction is prior to pandemic, the predictions from estimated AR model, as ARP or AR4, and bridge equation and extended bridge equation produce minimum root mean square revision in 55 or 77% of the components. And the extended bridge equation, where we have the credit card transaction data, didn't really show strong performance. So this is before pandemic. But during the pandemic, and the credit card transaction data did seem to have a stronger showing in the estimation. The revisions from null-casting models dampened spikes of revisions from the extrapolation procedure. It's easier to see graphically. So on the left side, this is the vertical line shows where the estimation and the prediction up to 2020 Q4. And so that the second one is 2020. If we put them together, you're not going to be able to see anything before because the magnitude change is so big. But we can still see this is the extrapolation, the big blue, and this is the extrapolation. And the orange is the extended bridge equation where we include the credit card data. Here also the extrapolation shows the bigger ups and downs. And similar pattern here, right? This is extrapolation. This is during the pandemic. This is also interesting because during the pandemic, the national account had to make an adjustment after they produced estimate. Because after produce the estimate, they can see, just really don't. It's all the trend from the past. So they make some adjustment, but we don't have that information to make that hard adjustments. But still, I think the estimation seems to have some advantages. Not in all the components, but in some components here we can see. And smaller adjustments and smaller revisions and milder ups and downs. So here's the conclusion. So to summarize the study, we have demonstrated the potential usefulness of null-casting techniques for improving the accuracy of advanced estimates of detailed personal consumption of services components, as they allow all available information to be utilized in estimation. The model averaging techniques in particular have potential to be a powerful tool in reducing revision in national account statistics at the detailed component level. So in our national account, we have been conducting parallel testing of these techniques to evaluate in real time, not pseudo out of sample, but in real out of sample setting. We have been doing this for 2 years, but the interesting timing of this is caught in the pandemic. So it's very hard to do a horse race when one side makes ex post adjustments and you don't. So, but this testing continues. Hopefully, given more time, we'll have. So there is some evidence that incorporating credit card transaction data could improve the null-casting performances during the period of sudden market fluctuation caused by the unexpected events, like but we need a further study to have a more definite conclusion whether credit card data are crucially useful when we have all the used. All right, so that's our current study. Thank you.
You? Yes. Sure. Okay.
Thank you so much for having me here. I'm Mehrotra. I'm Deputy Assistant Secretary for Macro Policy at Treasury, and I am not a expert in forecasting or time series econometrics, but I'll be sort of giving you my sense of my experience of nowcasting during the pandemic. I was at the Federal Reserve Bank of New York in the first year of the pandemic, and then I've been in Treasury since March of 2021. So hopefully this presentation gives you a little bit of a sense of how policymakers thought about nowcasting and how we were trying to nowcast during the pandemic. So to echo Neil's remarks right at the beginning of this session, we were hit by an unprecedented shock right at the start of the pandemic. It was clear by the first or second week of March that that there was going to be very large impacts on the economy, and the only thing that we track at a very high frequency at the New York Fed at least was jobless claims. And so even jobless claims, which come with a week or two of delay, felt like a long time to wait for a indicator of what was happening to the economy, and how could we size the impact of the pandemic into things that we cared about, which was GDP and employment. So if you remember back to the start of the pandemic, jobless claims went from roughly around 200,000 per week all the way up to 6 million at its peak. So an absolutely unprecedented increase in jobless claims. And from our vantage point at the New York Fed, again, we track a variety of indicators. Most of them are monthly and quarterly. And one of the few indicators that we were tracking that was at the weekly basis were jobless claims. And so it was clear very quickly that obviously there was going to be a very large impact on employment. And we did see that show up actually in the monthly data quite quickly. In March, 1.5 million jobs lost. So that came out in the first week of April. And then in the first week of May, we saw April employment falling by 20.4. So just huge decreases in employment in a very short period of time. And it was difficult even to take jobless claims. There's some relationship between jobless claims and employment. It was even difficult to extrapolate from jobless claims into what would happen with employment, given that there were, sort of people making multiple claims. The claim system was entirely sort of overrun. Now, just a month into the pandemic, or just weeks into the pandemic, fiscal and monetary policy also responded with a shock that was in many ways also incredibly unprecedented. So on one side, you have a pandemic with an unprecedented impact in terms of its rapidity on the economy, and then you have fiscal and monetary policy responding in equally sort of unprecedented ways. So taking us back to March and April of 2020, Congress passed the CARES Act, 2.2 trillion in pandemic aid. And a lot of this pandemic aid was coming out very quickly. So we had some experience in thinking about sort of transfers from fiscal policy that come out very quickly, but nothing of this magnitude. So just to refresh your memory, stimulus payments of $1,200 per person, or economic impact payments that totaled in the aggregate $300 billion. The Paycheck Protection Program, which also had no precedent, of nearly $400 billion, enhanced unemployment insurance of nearly $300 billion, and then other components that would be more traditional and would probably spend out more gradually. This was a huge amount of money that was coming out of Treasury very quickly. This was money that came out in a span of weeks, and so you are left with thinking about on the one hand, huge employment losses, huge declines in activity, and then on the other hand, fiscal stimulus that just in a particular month would be orders of magnitude more than monthly income. That monthly income was not just being filled; it was being more than filled. And then, of course, we had monetary policy responding as well, loosening the Fed, reducing the Fed funds rate back to zero, resumption of quantitative easing, and large lending facilities that were stood up in a very short period of time that many of my colleagues at the New York Fed worked on. Lending facilities to medium and large businesses that we thought would be very important at this in the pandemic, and that turned out not to be drawn upon very, very heavily. So that was the challenge for the for nowcasting was both taking into account an unprecedented economic shock and then an unprecedented monetary and fiscal response. So how do we go about nowcasting from sort of a practical point of view at the New York Fed? So the New York Fed has different models that we use to try and track the current and near-term path of the economy. We have our own New York Fed nowcast, which is what I'm showing on the right-hand side here is an evolution of our nowcast for the second quarter of 2020. We also have the New York Fed Dsg model, which is a structural model of the economy. We don't typically use it to inform our near-term forecast, but it does help us think about sort of forecasts in the coming quarters. And it is a calibrated structural model, so we do take the numbers that come out of it seriously. And then we had a separate sort of bottoms-up near-term forecast. So we have, just like the Fed has, top-down models. They also have bottoms-up models where they try and look at various components of consumption, various components of investment, and try to infer what is GDP looking like in a quarter and in the near term. And our process was complementing the Federal Reserve Teal Book process. So during that time at the New York Fed, I was working actually on this bottoms-up near-term forecast, which is much more judgmental, which is much more flexible than the models that we have. And the models that we have sort of completely broke. They did not perform terribly well. If you look at the nowcast for the second quarter of 2020, basically the models gets right the magnitude of the decline in that quarter, 30% annualized rate decline in GDP growth. But by the end of the quarter, it wanted to actually peg that number at around 15%, so half of what was ultimately realized. So the ultimate realization is down here. This is what the BEA reported for the second quarter of 2020, and you can see that's just a huge miss. And so we were not, and if you look at subsequent quarters, we had the same problem with the New York Fed's nowcast. And I think the reason that I'm not an expert in our nowcast, but the reason that it performed so poorly, and we somewhat sheepishly in the third quarter of 2021 stopped publishing New York Fed's nowcast because it was just giving bad numbers relative to other nowcasts. And I think the reason that it didn't perform as well as we would have hoped is because it wasn't taking into account the monthly data in the right way. And in normal times, this is not a big deal, but the monthly data, when you're looking at sort of, say, personal consumption over the quarter, once you get April and once you get May, you know 2/3 of personal consumption for that quarter. The model wasn't quite taking that on. So we faced a challenge during the pandemic. The nowcast wasn't going to be terribly useful. The DSG model wasn't going to be terribly useful, and we didn't have a great way for our sort of bottoms-up near-term forecast. So we tried to sort of, the other challenge that we also faced was that there was a very uncertain near-term forecast for the restrictions on activity. It had been clear that in April and in March and April that there had been this very sharp decline in activity, but it wasn't clear what even the near-term evolution of the pandemic would be. Would May and June be very different than March and April? And there was a rapid proliferation of high-frequency data that would tell us more about the decline, employment data like home base, credit card data, cell phone and other mobility data. It was difficult to take that data and figure out how to translate that into the indicators that we care about. So this was sort of the challenge that we were struggling with at the start of the pandemic. I think one of the things that we did at the New York Fed that turned out to be more successful was the weekly economic indicators. The weekly economic indicators was a project that was joint with Daniel Lewis, who's at the New York Fed at the time, Jim Stock, and Carl Mertens. And they basically looked at 10 weekly indicators, so jobless claims, but other set of weekly indicators, and tried to use that to come up with a nowcast of GDP growth. So the blue line here is showing the weekly economic indicators translated into GDP space. So this is year over year GDP growth as indicated by the weekly economic indicators. And if you take the sort of 13-week moving average, that gives you the dark brown line, and you can see that did a pretty good job of capturing the magnitude of what would eventually be reported in terms of GDP. So for the second quarter of 2020, GDP on a year-over-year basis fell around 9%. The weekly economic indicators suggested that fall would be around 7.5%. So that was good, but these errors are actually quite large, and they were it was again getting you in the right magnitude of the decline, but still giving you relatively large errors relative to what would have been common before the pandemic, and those errors actually have increased over time. But I think it was a more successful attempt of trying to take high frequency data and translate it into some of the indicators that we were interested in. So nevertheless, given this unprecedented environment, our forecasts changed very sharply. So if you remember back to that time, the Fed puts out its statement of its summary of economic projections every quarter. In 2020, we suspended the March projection. We're like, we have no idea. We're not going to make any projection for none of the Fed presidents were in a position to do that. The first projection we made was in June of 2020, and so from December of 2019, we went from 2% growth to negative 6.5% growth. This ended up being realized at only negative 2.5%. So we were clearly anticipating a much slower recovery in line with what had, despite the magnitude of fiscal and monetary stimulus, we saw the unemployment rate at 9.3% and at 6.5% in 2021, and obviously did not foresee any degree of inflation. Just at the end of the year, the change in real GDP was all the way down to 2.4%. So the speed of the recovery became clearer as we went on through the year, and better nowcasting helped us with that. but our forecasts still were, were quite a bit off because we misjudged the pace of the recovery. Turning to sort of my time at Treasury, we've been very focused on inflation, and we've spent a lot of time thinking about inflation. We've also tried to make some progress towards just nowcasting inflation. We've seen very large monthly increases in inflation starting in the spring of 2021. And in 2021, there were substantial swings in small components of inflation. Inflation since then has broadened out, but in 2021 there were idiosyncratic components that were driving high monthly rates. One of those was used car prices, and so we spent a lot of time learning about the used car market, trying to find high frequency indicators for used cars, also trying to find high frequency indicators for particular pandemic sensitive categories. So we do now, for example, follow a variety of indicators to track used car prices, which tend to be one of the more volatile components of core CPI. And you can see that the black line is the CPI price index for used cars and trucks, which has moved up something like 40% over the course of the pandemic. And in 2021, vehicle inflation accounted for, I think, about a third of the increase in core CPI. And we've used various leads and lags of different wholesale indices to try and predict used car prices a month ahead or 2 months ahead. This has been, qualitatively, this has been helpful, but I can't say that quantitatively it's been a huge success. We've developed our own models for shelter and food inflation, again, trying to build up a bottoms-up model of inflation. But that has also been those models tend to be very, very inertial. So the other thing that has dominated recent monthly inflation readings has been gasoline prices. And this is actually one area where one fairly volatile component of monthly CPI that is fairly straightforward to track. So we have been able to sort of indicate when when gasoline prices are going to pull down or pull up headline inflation rates, but that's very similar to what folks on Wall Street do as well. Forecasting gasoline is an entirely different sort of exercise. There's a great deal of uncertainty in commodity markets. All this being said, I do think that so the New York Fed's nowcast did not perform well, but other nowcasts I think actually held up pretty well. I would like to flag that Treasury has its own EP nowcast, which is not publicly available, but is available internally, and did perform fairly well over the course of the pandemic. The one-day absolute nowcast error from Treasury's GDP nowcast was second only to IHS and better than some of the judgmental forecasts from Wall Street. But even here, you see that judgmental forecasts, I think, performed a little bit better in that period of sort of maximal uncertainty around the second quarter of 2020. So, I think something else that has been important to keep in mind during the pandemic, and that is somewhat separate from just the question of nowcasting, is that the economic data has been the official economic data has been subject to restatement, and that sort of changes our interpretation of what actually has happened in the economy. So we saw large revisions, for example, to the employment data in earlier this year, and it changed the pattern of when employment gains were seen. So the orange bar shows employment gains before revision, and the blue bar shows employment gains after revision. And those million job gains in the summer of 2021 were revised down, and we saw much more employment, much more robust gains in employment in the second half of the year. And that actually solved the puzzle for us. One puzzle that we've been tracking during the summer was that the household and payroll surveys were diverging. We weren't sure exactly which one was right. It also sort of suggested that some of the commentary around the summer of 2021 that extended UI was holding back employment gains, because there was some view that these large employment gains in June and July were driven by the fact that certain states were ending UI early. That sort of narrative becomes less clear with the revised data. The participation rate also changed in January with updated population controls, and that showed more progress in the recovery of labor supply than we had originally thought. We thought labor supply had not moved, upward at all, but it had been tracking upwards over the course of the year. So I think that was always something important to try and remember during this time, that we put a lot of effort into trying to track the monthly data, but that data itself is subject to substantial revision. And something similar, I think, is true for GDP today. That there's a big difference between gross domestic product and gross domestic income. GDP has contracted for the last 2 quarters, despite continued improvements in the labor market, and GDI suggests a very different, paints a very different picture. And those two things are going to have to be reconciled. One I think interesting sort of experience during the pandemic in terms of nowcasting was thinking about the Omicron wave. During that time, there was a great deal of concern at the White House, at the CEA, that the economy would be hit very hard by the Omicron wave. There was a very sharp increase in case counts in early December, and our sort of pandemic teams were suggesting that the case counts would actually only peak in February and March. So they were projecting even further increases and a very drawn out Omicron wave. And there was talk at the CEA, there was talk at the White House. Does the economy need a fresh, need further stimulus? Should we be asking Congress for further stimulus to offset the impacts likely from Omicron? And there was little sign of impact in the weekly data. And what we had urged at Treasury at that point was that, let's look for some deterioration in the weekly data, and we didn't see that. So during this period, you see very little, impact of the Omicron wave on UI claims. And I think that speaks to one important lesson from this period, which was that there was a changing sensitivity of economic activity to the pandemic. It was very clear that if you looked at economic activity in certain sectors in the first part of the pandemic, there's a very clear sort of relationship between case counts and activity. But that really, sort of tailed off during the pandemic, and it spoke, I think, also to an important sort of an important sort of cognitive constraint that we faced, which is that sitting in New York and thinking about the pandemic from New York, or sitting in Washington and thinking about the pandemic from Washington, it was being felt in very different ways across the country, and you can't sort of overly extrapolate from your own experience. So what do I think? This is my last slide. What do I think are sort of the lessons of nowcasting in the pandemic? I think there was a huge proliferation in data and tools for high frequency tracking of the economy, and that this is great. This will be an important addition to our suite of tools for tracking what's happening to the economy in real time. And that there's a very strong demand among policymakers for nowcast. They always want to know what exactly is happening now and what is happening in the near term. And it does become relevant for policy formulation, as I was talking about with respect to the Omicron wave. So I think that there is particularly a demand for nowcasts that speak about the impacts on the distribution. So the credit card data does some of this, but there's a lot of interest in understanding distributional impacts of different shocks and being able to disentangle supply and demand factors. So when we're talking about Omicron, the question with the Omicron wave was, well, is this primarily a demand shock or a supply shock? Because that affects what policies we should be sort of articulating and should be pushing during that period. But you know, the other thing I think to keep in mind is that pandemic was somewhat unique. I don't think that aggregate fluctuations are typically going to take the speed and rapidity of what we saw in the pandemic. And so building too much architecture around the pandemic for the future may not make huge sense. And then the last point I would make is that better nowcasts have a limited ability to create better forecasts. So it was the case that we got better at nowcasting the economy and understanding what was happening in real time during the pandemic. But our ability to forecast, I think, really hinged on recognizing that there was changing relationships with the pandemic and activity, and that there was some value in stepping back and thinking, from a theoretical perspective, what do we think is going to happen? And so people who proved to be a little bit more, shall we say, prescient during the pandemic were people who I think were less focused on the question of what is happening now and more focused on, okay, given the magnitudes of what is happening, how do I think this is going to impact the macroeconomy? I can talk more about that during our Q&A. But thank you. Thanks.
Good afternoon. Good morning, everyone. My name is Jason Schachter. I'm Chief of the International Immigration Branch at the U.S. Census Bureau. We produce annual estimates of international migration flows to and from the United States, and these are fed into our population estimates program, which we use to produce estimates at the nation, state, county level by various characteristics. The pandemic definitely impacted the way that we typically measure international migration, and it forced us to come up with some new methods and integrate new data sources to enable us to produce more accurate and timely estimates of international migration. You'll notice I don't have nowcasting in my title here. So I don't know if any of these examples I'm going to give you are actually be considered nowcasting, but regardless, hopefully there'll be a lot of similarities to the stuff that we're discussing here and the same sort of issues and challenges that we're facing, trying to improve measurement. First, again, the need for timely and accurate data. International migration became extremely urgent during the pandemic starting in March of 2020. There are also already, even prior to that, there's a number of challenges using migration data. First, the U.S. administrative records on international mobility exist, and we have a decentralized statistical system. So data is collected from all different agencies. The Census Bureau collects information from censuses and surveys, while other information comes from, I'll show later. It's very difficult through data exchange to have not timely, and there's a lot of hurdles that have to be faced when getting data from other agencies. So we're really stuck with the type of information we can use, limited. Different agencies use different reporting periods and have different definitions of migration. Also, data tends to be fragmented and not representative of all international migration. So at the Census Bureau, our traditional data source that we've been using for the past 10 years or so is the American Community Survey. That's a large annual household survey of about addresses, and it provides very comprehensive data on immigration to the United States. However, that data is lagged. think if there is a shock to the system, it prevents us from being able to use that accurately, such as when COVID-19 struck in 2020. That also impacted the quality of the data because of those high non-response bias was found with the 2020 ACS, which meant we had to look for alternative data sources to use. Anyway, again, we produce population estimates for the July 1st to June 30th reference period each year. Because of when the data collection of the ACS occurs, those estimates we use for migration lag about 1 year or more from that time period. So this normally isn't an issue when patterns are stable across time, which they used to be in the past, but when things change, you have to make adjustments. So in terms of what we're looking at for our estimates, there's 5 pieces that go into our estimates of migration. First are the number of foreign-born immigrants who come to the United States. Then we subtract out those who leave the United States. Then we add in the net of Puerto Rico to US migration. Could be in either direction. Normally it's a net gain for the US mainland. We have a net native component, which is the native-born population, which is relatively small. The last piece is a net armed forces movement, which is produced by another part of our area. Gives us our final estimate, which we call the net international migration. So this is the pieces that we have, the puzzle that we need to adjust when needed. ACS, so I mentioned earlier, it's a large annual survey. It started in 2005. 3.5 million addresses. There's different files based on the level of geography that you want to use. A lot of migration relevant questions like country of birth, year of entry, country of residence 1 year ago. That's our primary variable for measuring migration flows to the US. As I mentioned, there's been a lot of increased non-response and imputation with this survey, especially in the past 5 years, which has limited our ability to trust some of the accuracy of the data and to use it. And also, as I mentioned, the timeliness of the data, so it can be problematic when there are shocks to the system. So this is an example of some recent migration shocks. 2016, there was a lot of policy change and anti-migration rhetoric, which caused some changes in patterns. 2017, this is one of the first major ones where we had to make changes, was due to Hurricane Maria when it struck Puerto Rico. And you can see in more recent years, the shocks are becoming more and more prevalent, more and more frequent. We had COVID, we had an earthquake, another large earthquake in Puerto Rico in 2020, January. Then we had COVID in March of 2020. We had a border surge in 2021 of crossings, of unauthorized border crossings, just continues to today. 2021, we saw a large influx of Afghan refugees. This past year, Ukrainian refugees, and I think this is telling us that perhaps in the future there'll be even more shocks if we had recession, policy changes, wars, droughts, famine, natural disasters, etc. These could all drastically impact the number of migrants that are coming to the United States as well as leaving. So our first sort of test before the pandemic, we had a test run with Hurricane Maria. This was a huge hurricane, which hit Puerto Rico, not much larger than what they recently had with Fiona. That actually caused the collection of data to cease in Puerto Rico for 3 months. And then the data, when we actually looked at the data, it did not show a large number of migrants coming to the US from Puerto Rico. So we realized that the ACS was not picking up the hurricane, which was reported in the news as being. So to account for this, we use monthly flight data to account for the impact of that large surge from Puerto Rico to the US after Hurricane Maria, as well as in the subsequent years. We found a historical relationship between flight data and ACS data prior to the hurricane, which we used to set sort of our adjustment factor. It's what we call a macro data integration method. And this is sort of served as the springboard for what we ended up doing with COVID. That's why I'm talking about it right now. And we had to use the similar methodology again in 2018 to account for return migration to Puerto Rico, and also for COVID in 2020 and 2020. This shows historical relationship between the ACS and the flight data. You see flight data generally higher estimation of migration from Puerto Rico. And then the last, in 2017, you can see where the ACS and the flight data diverged. So we took the flight data as the true value and we adjusted it downwards to reflect what it would be if the ACS were actually picking up the actual migration that happened. This is what it's 120,000 rather than minus 77,000. And in terms of the pandemic, a lot of people probably did, I mean, at least in population statistics, they didn't think about the impact. They thought about deaths, the impact on deaths and births, but it also had a huge impact on international migration. First, there was a lot of policy changes. They closed the border, land border between Mexico and Canada, except for extreme cases that lasted for 16 months. There were also flight restrictions from China, for example, in February, and the European Union in March. And that led to 98% reduction in international flights. And those restrictions weren't lifted until November 2021. So combined with visa restrictions, the number of issuing visa offices closed outside the United States immediately after the pandemic. So people who could come to the United States weren't able to get legal permission to come. They didn't start opening up again until the summer of 2020. And there were also a lot of policies that were anti-immigration in terms of reducing the number of immigrants coming. There was an executive order banning the travel of non-residents from certain countries. There was a pause on legal immigration 2020, end of the year. So that obviously had a huge impact. And that was then expanded to include all forms of legal immigration. While February 2021, they reversed the policy and green cards began to be issued again. See that, see the data this year. So in terms of the adjustments, we would normally have used the 2019 ACS, but we knew that that did not cover the COVID period. We made individual adjustments to each of the different pieces based on other data sources that we found. So for foreign-born immigration, we used visa data and I-94 arrivals. For foreign-born immigration, we look at Canadian and Mexican data to see people moving to those countries. For the net native component, we look at US flight data to and from the rest of the world. And also, we got special tabulations from Canada on some administrative data on temporary and permanent residents from the United States. And as I showed before, for Puerto Rico, we used the US flight data. And this led to significant decreases for foreign-born immigration and emigration, reduced net outmigration for natives, and reduced things by about 24%, which is if we basically set it to zero. So this was a partial year adjustment that we made. Now, here's some examples of what the data looked like. This is the flight data. You can see that huge drop in April of 2020. By June, but remember our estimates period is until the end of June, so July 1st. It had not recovered. It was at 2% of prior levels. There was also a bit of a bump in February and March, which we assume were people coming back to the United States ahead of border closures, because the State Department had issued a lot of warnings to U.S. citizens residing abroad or visiting abroad that they might be closing the border. Here's the visa issued overseas. Again, in March, April, May, you see the huge decrease in the number of visas issued in 2020 compared to previous years, which essentially follow a seasonal pattern. Again, this is further evidence we use to make our adjustment. For immigration, this is the Mexico travelers to Mexico by land on the left-hand side. You can see the 2019 numbers, and then 2020. Again, dramatic drop in the number of border crossings between the US and Mexico. Similarly, for Canadian citizens returning to Canada by air, we saw that huge drop of people entering the Canadian. So the next year, we knew we were expecting that we were going to have to make further adjustments. We'd have similar issues. Now, this, instead of the 2020 adjustment was based on a partial year, but this would be a full year because the 2020 the 2021 estimate period covered the entire COVID period. There's also a huge impact on the ACS. They lost a third of their sample because they couldn't go out to households and get responses. And that disproportionately impacted certain groups. The Census Bureau did produce special weights to try to cover for this, but it wasn't, still reduced, it did not reduce the undercoverage for foreign-born. So we still had an issue there using it for migration estimation. So we had high levels of non-response, high refusal rates, high imputation, and finally, the Census Bureau declared the data set experimental and said it was not directly comparable to other years. So rather than using the 2020 ACS, had to make a full year adjustment using similar methodology to before, but a little bit different. This time we developed a benchmark database which collected data, the statistics, publicly available statistics from various agencies. This would allow us to forecast NIM for that COVID period. There's some limitations in that it's intended to be administrative metrics, not measures of migration. You have to really be careful looking at administrative data because it's not necessarily the same thing as migration. It could just be movement, for example, across borders. You have to be able to gauge someone who's coming or going on a sort of permanent basis. And also, you only get it at national aggregate level, so there's a limit. You don't get like characteristics normally. So these are the right-hand side. These are some of the time series that we use to help make our adjustments. See the U.S. consulate closures, and then they gradually increase over time. The number of student visas issued. There was a large period where we didn't have any students, new international students, and that was reflected in this data. Then for the last one to show how Puerto Rico, how it impacted the flight there. These are all the things that we fed into our models that we used. So this is a sort of accumulation of the different benchmarks. It shows the black line above is what our ACS-based estimates have produced over time. And you can see they're relatively consistent with what the administrative data show. So because we felt confident there was a relationship between the administrative data and our ACS-based estimates, we thought we could use the 2019 data to project forward. Let's see, so we used the 2019 data. The 2020 figure there is the adjusted figure. So we used the 2019 data and adjusted it downwards. The same slope that we saw the administrative data declining period to produce our estimate. This is here. We produced what we call low, middle, and high benchmarks using the middle benchmark, which corresponds with the projection. So, so yeah, we basically use public data as well as special tabulations from OIS, the Office of Immigration Statistics and Statistics Canada. Use the ratio of change between the 2019 and applied it to our 2019 ACS value to get our. All right, now the questions of what we're going to do this year. Most of these immigration restrictions have been reduced or see, this is what the benchmark data shows us as sort of a predictor of what we would expect. In 2022, you can see levels are back to basically 2019 levels. We have that top variable, is this not notice to appear, notice to report. That's actually a measure of unauthorized border crossings to and from the United States. It's a relatively new policy during the Biden administration. So we have data for that for 2021, 2022. But excluding that, you can see that the levels in 2019 are basically the same as 2022. So given what the ACS cut came in much lower, it hasn't been, I don't think it's been released yet, but it'll become much lower than what than 2019. Again, we'll have to make adjustments this year to control. In terms of alternative data sources, we're active and looking for whatever data we can get to use. We have some data sharing agreements that we've established since COVID happened. We have one with BTS to get early access to flight data. Gives us access about 3 months earlier than the public. We're also trying to get a lawful permanent residence file for the U.S. CIS, U.S. Citizen and Immigration Services, as well as help HHS to provide refugee information on refugees. We're also trying alternative methods to leverage our administrative data that is available at the Census Bureau by linking IRS, Social Security, and ACS data. I will try to use that to develop new immigration rates rather than having ACS, having something that's more recent enough. This is an example of some of the data that's collected by different agencies, and the blue are the ones that we have access to. See, there's a lot of cross-border information collected by Customs and Border Protection, but that's basically impossible for us to access, so we can't get. That would provide sort of up-to-date, day-to-day, real-time information, which would feed into sort of an outcasting model. Access to that. In terms of discussion, Our emphasis is on projecting trends, not comparing the actual levels. So we really depend on trends between different data sets to do our estimates. Is this an example of nowcasting? Probably not, I would say. I mean, it does reduce our one-year data lag down to about 1 month in some cases. We could possibly project months or quarters, but we'll never be able to do it for weeks or days. There's a couple of other issues. One is that we produce estimates on an annual basis, so we don't need to have them on a daily basis. And also, the definition of migration is based on usual residence, and you need to have been established residency to be considered a migrant. So again, you need some time to pass before you can actually do that. It's 2 to 3 months. But this is an example of what we call macro data integration, using aggregate data from multiple sources to produce a single estimate. And the other, with the item, which I mentioned earlier, which is our combining of IRS and Social Security data, that would be micro level data integration. That's using individual level and internally used federal data to measure migration by subnational geography and demographic detail. So in terms of the future, data integration, I think, is going to become an important feature of our statistics, not just in the US, but globally. The idea is to draw from the strength of each data source, mitigating their weaknesses. We're going to continue to pursue these avenues of research, try to do more stuff with administrative data. We've tried combining it with ACS recently, which was pretty successful, especially as we feel that survey-based data by themselves will be less tenable in the future. Issues about data privacy right now. Non-response rates are extremely high, especially for foreign-born respondents. So definitely going to have to use more non-traditional data sources. So that's it. But thank you.
Thank you. And I'd actually like the 3 panelists to come up to the front, and we'll have time for questions from the audience. Questions, comments, Prakash?
Thanks very much. These were all very interesting presentations. A couple of questions for you. I think if I heard you correctly, you said Treasury is doing a nowcast of GDP, but not publishing it. What is the thinking behind not doing that? That's one question. The second was, given the inflation miss that all of us, my agency, the IMF, as well as Fed and elsewhere, kind of missed the inflation. I mean, what is being done to sort of try and track inflation better? You talked about it a bit, but is nowcasting going to help? I was struck by your conclusion that you actually think that nowcasting will produce better forecasts. I was wondering if hope that inflation over the coming months or years, which will be very critical. What are you guys Treasury thinking about how to improve inflation?
Yeah, great questions. So the short answer on the GDP nowcast is, this is something that was used in the mid 2010s, as an internal tool. Treasury doesn't typically put out sort of many outward facing forecasts, and I think it would be unlikely that we change that. But it is proven to be I was struck at its excellent performance, and lots of credit to David Griffiths and Andrew Martinez who developed it and tweaked it over time. And I don't see a particular reason in not having it out there, but the Atlanta Fed Nowcast, for example, gets a lot of attention and has it does get a lot of focus. So I think that's a consideration that would that our public affairs people would have to be okay. On inflation, I think the reason I say that I don't know that the nowcast has helped too much with the forecast is we have gotten better at thinking about individual components of inflation, but as inflation is broadened out, I think that exercise has become less useful. And the sort of large idiosyncratic movements that you had in used car prices, that you had in gasoline, I think have led to too much thinking, too much optimism with respect to inflation, because well, you can explain this month, by looking at this, and this month by looking at that. We all hope for inflation to go down, but I think that the folks who have had a more macro view of inflation and have focused on, at least in 2021, the speed of economic growth, the rapidity with which unemployment came down, the underlying sort of momentum in core prices, they have, had a more realistic sense of where inflation is going. And so we know that historically inflation is very persistent. And so, to a first approximation, what inflation was last month is likely what it will be this month. And I think that, some of the nowcasting, some of the focus on the underlying components has tended to sort of miss what you would get from more sort of from that heuristic of thinking about, inflation as just a highly persistent process and thinking about it from a more macro.
I may. Morning. Is it on? Okay, thank you. Good morning, and thank you to all of you for your presentations. I have a seemingly odd question, and it has to do with the manner in which economic transactions are recorded at the retail level and then transported or moved to the statistical agency. So here is what I have in mind. If the economy were to be digitized, so all transactions are recorded virtually instantaneously, would that eliminate the need for nowcasting? Whoever.
Who is the question addressed to?
A BA.
I think what I'm thinking about is BEA compile GDP estimates using source data from all different sources. So if all the transaction in the economy is digitized, which means we can instantaneously get all the information. That does sound like a movie. What the world is going to be. It still has to have data, survey data. You have process, and I'm not so sure because we don't just get, let's say, what you spend in the store that will put national account. It still has to have some process of the data collected from survey from different sources. I don't know if digitization of all aspects of the economy will change that process. We have to see changes.
But it will not keep it the same. Right? The BA wouldn't go and get data in the same way if the entirety of the economy were digitized. So what I'm thinking is, so how would that affect nowcasting? To the extent that the delay in getting the data.
Okay, if there's no delay, for example, what I discussed today is for the services, the first month after the quarter, we don't have data. So we can't immediately tell the public what the services was in quarter just finished. We have to wait a month to get the data. If there's no such delay, if all data come with no delay, then we wouldn't have to use indicators, right? We just use the source data. And it does sound like a movie. I'm not sure when that can happen. In terms of GDP estimate, it really, if you think of a GDP, what the public see was the total GDP. But if you work at a national account, you see thousands of components and together. I haven't tried to imagine all these, come instantaneous.
Thank you.
But would be nice, right?
That's my take.
Also, just as a follow-up comment on that, even the types of transactions going on were themselves affected by the pandemic. It's not only that the pandemic was a shock in itself, but some of the relationships changed. And a good example is a number of retail stores, coffee shops, you name it, switching to being no cash. Whereas before, they were small transactions and would have engaged in cash, but then they became no cash. And so you have a different interpretation of the measured data and a different relationship with that measured data. And that's something, a more general issue that I think that all three presentations brought up, is that these shocks are not only shocks in themselves, but they may change the relationships that we're dealing with, at least with the measured data that we have.
Let's say on the measured data, I do think it would help with getting very quick information about, existing products or for existing firms when it comes to employment, but you still have the entry exit margin to deal with. You still have the same sort of issue with respect to the CPI of changes in product quality that you're trying to adjust for. Obviously, a huge part of CPI is the housing component. So, I think that those strike me as sort of still, key issues in terms of real-time tracking.
The reason why I thought of the asymmetry is that you don't see now casting for measures of the money supply. You don't see now castings for measures of the interest rate or for virtually any financial indicator. And the difference between, let me call it the real economy and the financial economy, is the speed with which the transactions get recorded. And so I'm thinking, well, to the extent that that speed takes over the rest of the economy, then to that extent, I would anticipate reducing the delay and ultimately reducing the need for nowcasting.
Well, I think about the credit card transaction data that we use to feed our estimates. And so this Pfizer Corporation collect all the transaction data on daily basis. They still have to, you can't just collect them and use them. You still have to process them. There are like merchants come in, merchants drop out, and also month to month and week to week, there are certain economic dynamics that they have to look into. It's not like there's a transaction, the data put in the national account. I still think there is time to process, might be faster, but there still has to be process time. We actually use the data to produce. I believe the current Pfizer data, there's very extensive research went into that to use a 13, was it a 13 months and average? So, and to track the merchants that coming in, merchants come out, also gave you a kind of a stable, even that is seasonally not adjusted, then you have to adjust this seasonality. Don't know, I picture that, but I still think there will be process.
I would think that the main reason for the delay, let me call it unavoidable delay, is the need to separate or identify whether the transaction corresponds to a final good or service. It's just not enough to record transaction. For GDP, they have to be final. And so in the case of the BEA, they're going to get tons of transactions from everywhere. So is this a final transaction? Yes or no? And so that, I think, is an unavoidable delay. I just think that it doesn't have to be as long as it is now. That's what I'm getting.
We have time for one more question.
I'll check one for Jason. Connected with this IDM I mean, doesn't seem to be doing what I thought you might be doing, which is something we do for exports. When you want to check whether export data are good, you look at the import data of countries, and that gives us a cross check. You do a similar thing for migration, but I guess that's not what you have.
Not for that project, no. It's difficult to get information from other countries, and they might use different definitions or different time measurements. Yeah, the UN works on sort of these cross-country matrices that can try to do some comparisons of flows, but it doesn't work very well. Stock and flow, I mean, that is usually pretty consistent.
So, thank you to our panelists, and we'll break now for lunch. Let's first thank you.